Okay, but it's still okay. They think. Huh? Started. Yeah. So let's continue the discussion. I'm really sorry. Okay, there's a problem, technical problem. Okay, so let's start with where we happen to stop. Okay, so okay, since we missed the continuity, let me just remind what we've been discussing before the break. So we've been emphasizing on the reason why the current argument or the discussion has been brought into picture, because the government on one hand is primarily focusing on incentivizing markets to drive the growth, but that could only happen when the interest rates would be cheaper. But since the RBI chasing inflation, that's a headline inflation, as of now, which is primarily driven because of high rising prices of food grains, the the chief economic advisor happens to bring this argument. Is it really worthy targeting inflation, that is headline inflation, in a developing country like India, where the food grains or the food basket happens to have very high weightage? And the food inflation is basically a supply side constraint. I mean, the reason behind it's basically because of supply factors. To what extent the central bank policy would be effective in containing. So that's what we've been discussing. And as a continuity, I was also explaining how the monetary policy as of now in India is reviewed. Remember, I already said once in every 2 months, the monetary policy committee, it's not the RBI governor and his team alone, it's basically reviewed by the monetary policy committee. In fact, even this recommendation is from the Urjit Patel committee itself. So as of now, since September 2016, the monetary policy is reviewed once in every 2 months by 6-member committee. 3 members happens to be from the RBI, which obviously includes the governor of RBI. And the other 3 members happens to be the one appointed by government, not necessarily the government or bureaucrats, or basically not necessarily part of government, they're just outsiders. In fact, it is in the same article that I was referring to, that Mr. Anant Nageshwaran happens to come up with. He says that if the government could play a very important role in containing inflation, especially food inflation, should government also have representatives in that particular committee which basically targets inflation? That was a different argument he happened to bring it. Should there be a government present in that particular body which makes decisions related to the monetary policy review with a target of containing inflation? So that was a different argument he also happened to put forth. Should there be a presence of government? Of course, if you look at most of the nations across the world, you don't have any presence of direct members of government in the monetary policy making. The only exception is Russia. But if you look at the Federal Open Market Committee, FOMC, so what we is very similar to our MPC. Our committee with their 6 members, they have 12 members, but everything remains more or less the same. These people meet once in every 2 months, and this committee happens to meet once in every 45 days. Hamara 6 times in a year, and they happen to meet 8 times in a year. But at the end of the day, they do also come with the same thing. Their primary objective is again target inflation, and these people come with a policy rate. What should be the ideal policy rate? And these people come with the Fed fund rate. So if you notice, more or less the arrangement seems to be very same. So the reason why I've been again, I have come back to the monetary policy committee or the decision making related to the setting of interest rates is to continue our discussion related to monetary management and financial intermediation. So as such, we know, and I assume the fact that you know that the monetary policy committee is the one who happened to decide on what should be the ideal rate of interest rate. I mean the short-term interest rate, what we people call as a policy rate. Okay? And as already stated, since May 2022, we've been on the spree of increasing interest rates, and right now the inflation, okay, the policy rate happens to be somewhere around 6.5%, and for more than 1.5 years, the interest rate or simply the lending rate of interest, the bank RBI charges on the banks, the repo rate is being kept at 6.5%. So now we're going to continue a discussion related to monetary management and financial intermediation, keeping this fact in mind. That is the interest rate, I mean to say the policy rate, the repo rate, which is a short form of repurchase rate, is being at 6.5%, and the recent policy review in the month of August, the monetary policy makers happens to prefer maintaining a status quo. But before going ahead, let me also make it clear one more interesting fact that happened to take place in the August policy review. So we are right now in the month of September, and the policy review, the recent policy review is in the month of August. And in this particular policy review, within 6 members, 4 members happens to prefer a status quo, because they believe the inflation is not yet under control, and they still believe the interest rate should be kept at the same levels. But 2 members, one is, I think, if I'm not wrong, Ashima Goel, and then the second member, Verma. So 2 members have in fact suggested that it would be better if the repo rate would be brought down at least by 25 basis points. I mean, 2 members have supported the idea of bringing down the rate of interest, but 4 members preferred it is better to maintain a status quo. I mean, Professor Jayantar Verma and Ashima Goel, they prefer bringing down the interest rate. That's what their suggestion is. But you know the fact that decisions by MPC are taken on a voting basis, majority. So the majority prefers status quo. That's what's the reason they happen. But the reason why, you might be asking, when you already said, and it's clearly presented by the government itself, that the inflation in India is around 5.4% in the last year, isn't it? And we didn't experience much of deviation from 4%. Unlike other nations, our deviation is not really so high, isn't it? In such case, what's the point of keeping interest so high? And that too for a longer period of time. Is it not hurting our growth? And that's the very basic reason these people have suggested, let's bring down the interest rate at least by 25 basis points. But now let me ask you a simple question. Do you really think, though it's been explicitly clear that RBI's primary target is to contain inflation, but do you really think RBI primarily focus only on inflation, and you think there are no other factors the RBI takes into consideration? So, in fact, to just give you a clue, I already have written an article that I have come across in Indian Express. Remember, I said there's an article where they happen to say, does RBI target food or fed? In fact, this is what I've been discussing before the break. So why does this middleman happens to come with this particular statement? Does RBI target food or fed? Is RBI chasing food or fed? The reason, he was just trying to comment on the unscheduled policy review that happened to take place in the month of May 2020. And his argument is, in spite of the RBI being aware of the fact the inflation in the month of February itself has crossed way beyond 6%, then why wait until May? Because in April you reviewed it and you still simply kept the interest rate 4%, and you have the next review at June. Why not wait up to June? Why the hurry? Why the unscheduled policy? And he says, are you really worried about food? In such case, you have taken this action much ahead, because remember I said in this unscheduled policy review, the repo rate has been increased by 40 basis points, and then the CRR has been increased by 50 basis points. Why now? Not only this gentleman, a good number of people happens to come with the same question. Why this unscheduled? Why this basic surprise? So the argument is very simple. Okay, the purpose of going for this review, unscheduled review, and going for increasing interest rates obviously is one to primarily contain inflation, no doubt about it. At the same time, many people do happens to also come with a conclusion that since the inflation in this developed part of the world, like in United States of America, UK, has been the highest. And you know, in the month of June, the Fed is expected to go for its policy review. And one can easily assume the fact when the inflation in US is so high, because their target rate, inflation rate is 2%. But when the inflation is around 9.8%, definitely one could easily come to a conclusion the Fed would definitely go for a increasing interest rates. Because not only the RBI happens to bring down the repo rate to 4% or bring it down to low rate during COVID, even the Fed has done the same thing. During COVID, the interest rates in US has been brought almost to near 0.4%. In fact, it's a near zero. But when the inflation is so high, it is quite obvious that the Fed is gonna move from this accommodative stance. So now the question to you is, if the Fed, because it is their problem, the inflation is way beyond their comfortable rate, they are obvious, isn't it? They're obvious, it's expected they go for increasing interest rates. But the question is, what is the Fed rate gonna do with India's interest rate? Will there be any impact? Will there be any impact of the Fed rate or the rate of interest prevailing in United States of America or the Fed funds rate on the repo rate? In fact, the reason why I happen to come with such kind of conclusion is, are we really concerned about the food inflation or it's really concerned about Fed? So his basic conclusion or his argument is that the RBI not only worried about inflation, the RBI is only worried about the increase in interest rates in United States of America. Anticipating the Fed might go for increasing interest rates, the RBI governor might have gone for taking a step before the Fed does it. Because the rupee those days was experiencing a downfall. One, because of increase in import bill due to the Russia-Ukraine conflict. Because the Russia-Ukraine conflict not only costed the American economy or UK, isn't it? It has its impact across the globe. So the rising price of import basket started resulting in rupee depreciation. And at times when the rupee is depreciating due to the increase in cost of import bill, now what if the Americans go for increasing interest rates at times when interest rates in Indian markets is going to be lower? So that might result in triggering a good amount of capital outflow. And that might further add up to the fall in value of rupee. And that's what's the argument of this gentleman. And what he says, though the primary focus might be on containing inflation, but inherently the reason behind a unscheduled review could be to simply take a preemptive action before the Fed go for increasing interest rates, so that by increasing interest rates, we in India trying to discourage any capital outflow. So this is something I just want you to keep it in mind until we complete, okay, isn't it, the topic that's monetary management and financial intermediation. So matlab hai, though we explicitly say the RBI do karke happens to target inflation to keep the inflation within this range, but it also happens to keep in mind the interest rate regimes of other parts of the world, especially in the developed nations. So it is under this atmosphere, at the prevailing rates, let's look at what's the state of our monetary policy, monetary management and financial intermediation. So before going ahead with it, let's see whether you could answer these questions. So here is the question. Consider the following statements. The weightage of food in CPI is higher than in wholesale price index. Okay, so in fact, that's what our discussion is. That WPI does not capture change in prices of services. That's one of the lacunae of WPI. Okay, whereas CPI does it. As said, CPI tracks the basket of goods from around 6 different categories. Maybe you are aware of it. And the RBI of India has now adopted WPI as key measure of inflation and to decide on changing key policy rates. No, in fact, remember I said in 2016 as part of monetary policy framework agreement, it is explicitly cleared the RBI has to focus on headline inflation computed using CPI, and for this cannot be a right statement. and I guess you could make it out the right answer. And now look at the question related to Monetary Policy Committee or Monetary Policy Framework Agreement. Consider the following statements. The RBI will be responsible for containing inflation target at 4% with a standard deviation of 2% in the medium term. So no doubt, that's what we already discussed. The central government determines the inflation target in terms of CPI once in every 5 years in consultation with RBI. In fact, most of you would have a perception, since inflation targeting happens to be now the basic objective, so you might happen to have a presumption that RBI is the one who chooses what should be the desired rate of inflation, but it is the government of India in consultation with the RBI chooses this desired rate of inflation that we need to target. So henceforth, even this statement happens to be correct. The third, if RBI fails to achieve the specific targets for 3 consecutive quarters, it is required to submit a report to the central government. Yes, and it is part of the agreement. The fourth, the report also expects to provide an explanation for the reason or sources of inflation and at the same time forecast of inflation for the upcoming period of 6 to 18 months. Even that's part of the agreement. So by this, okay, I hope you could make it out all the above statements. So now let's move on to the next part, that's the monetary management and financial intermediation. So by this, you're already clear. As of now, the repo rate for a longer period of time is been around 6.5%. So iska matlab hai, let me repeat, the repo rate is basically a short-term lending rate, the rate at which RBI lends to the primarily to the banks. So we're not going to discuss about anything, okay, primary dealers, but majorly the borrowers happens to be the banks. And you know, this particular repo rate, which we also call as a policy rate. Policy rate. So let me, okay, for those of you people who might still have a confusion, repo basically is what we call is a short form of repurchase rate. The reason why repurchase rate, it's very simple. When these banks are in need of money, badly in need of money to meet their short-term requirements, tarika kya hai? They do take some assets. What are those assets? Mostly the government securities. So these particular government securities is what these banks, at times they need of money, they happen to pledge with the central bank with a promise to buy back the same asset after a certain period of time, along with a certain rate of interest. So what basically the banks are doing when they are in need of money, they approach their banker, none other than RBI, and they exchange some assets. And the assets in this case happens to be the government security, with a commitment to buy back the same securities on an overnight basis. And then we have a term repo for 7 days, 14 and 21 days. But ideally, this is the practice that happens. So something very similar to the gold loan. When people want to go for borrowing money, and they were, okay, what do? They generally pledge some asset as a collateral. And the banker do charges at an interest rate, and the deal is whenever the borrower comes back to the banker is expected to sell the asset back to the borrower after paying the principal interest rate. And same thing holds good. So I am pledging my government securities, and I am just pledging, okay, making a commitment to buy back the same securities back with a certain rate of interest paid. इसी वजह से ना we call this as a repurchase rate. I am repurchasing the assets that I have placed as a collateral with my banker. And the short form of repurchase rate is repo rate. But the reason why in India we call the repo rate is there are other rates in India which the central bank uses to manage the liquidity. And I think most of you are aware, just for the sake of convenience and for the, okay, ensure that it would be a better revision, let me also revise, okay, revise what are the other rates. So repo is the rate at which RBI lends to the banks. And whenever banks borrow money from RBI, what's the common practice? They pledge an asset. What's the asset? Mostly the government securities. Again, if the same practice is done by the RBI, that means if RBI borrows money from banks for short term. And how does RBI borrow money from banks? The same logic. Okay, it pledges some government securities banks with a commitment to repurchase back from the banks after a certain period of time. So since it's happening exactly in reverse of what happened here, इसी वजह से we call this rate as reverse repo rate. We call this as a reverse repo rate. So if you have noticed it, the repo rate is what RBI charges on the short-term loans, and reverse repo rate is the rate at which RBI borrows money from the banks. So at the end of the day, I could conclude repo rate is mostly used to inject liquidity, and reverse repo rate is mostly used to squeeze the liquidity. So at the end of the day, these particular instruments are used by central banks to adjust the liquidity within the markets. That itself is the reason why this facility is very commonly referred as liquidity adjustment facility, which was introduced somewhere around 2000. इसका पहले the government, central bank used to use bank rate. The rate at which RBI lends money to the banks used to be at bank rate, and it's a long term compared to the repo rate. But no longer it's primarily used to adjust the liquidity. As of now, the most commonly used instrument to adjust the liquidity is repo, and then the other is reverse repo. I hope you understood the essence of liquidity adjustment facility. And then later in 2008, somewhere 11-12, somewhere around this financial year, due to the aftermath of economic 2008 financial crisis, the RBI has come with one more flexible rate, a flexible instrument to ensure the banks would be having liquidity in a very short notice. In fact, I would say the instrument the RBI has come with what is very popularly referred as a marginal standing facility. So which is more flexible than the repo. Okay. So in fact, even you might be aware of the fact that even this is basically the rate at which RBI lends money to the banks, but it's more flexible. Matlab, in what way? If you look at repo window is not available in all working days, but it is MSF, it's available all working days of the RBI. And in case if the banks need money, they could also pledge those assets that's part of their SLR requirement as part of their MSF window. When it comes to repo, you're not supposed to use those assets you are mandated to maintain as part of SLR. But when it comes to this rate, you have more flexibility where if the window is available all working days, moreover, you could also use the assets that's part of your SLR requirement to pledge against which you could borrow money. So since this particular instrument is more flexible, by that logic, one could obviously conclude the fact that this would be costing more than compared to the traditional short-term repo rate. So that's the basic reason. As of now, you will be noticing the MSF rate. It's not as of now. Ideally, it has to be more than repo rate. Am I right? The reason MSF is more flexible. And since the time MSF has been reduced, it's been pegged with bank rate. So since 11-12, you could notice the fact the MSF and bank rate seems remains one and the same. So I have now it's clear you have repo rate and then you have MSF, which is more than the repo rate, and then the reverse repo rate. I hope these are the rates that you people are very much clear now. And the recent innovation or the recent initiative the RBI has brought in is standing deposit facility. What is the standing deposit facility? How is it different from the other rates? I'm just brushing up, your basics, just to, ensure that discussion would be smooth, because there is nothing new as part of monetary management financial intermediation. So you only get to know what has, taken place in the year of 23-24, and to understand better, I'm just trying to brush up your basics. That's it. Okay. So the initiative standing deposit facility is a very recent initiative. So what's the idea is simple. See, in case of excess liquidity, if the RBI want to squeeze the money, the basic practice, the RBI has to go for pledging some assets against which it has to borrow. That's what as per reverse repo rate. But what if the RBI need to squeeze much more money and RBI might not have enough securities or enough assets to pledge with the banks? So that's where the RBI has come with an opportunity and a initiative. where it simply says, in case you banks happens to have any excess liquidity. Generally, when banks happens to have excess liquidity, when I say excess liquidity, does mean don't ever think that all the money banks raise in the form of deposits is what they could be able to lend to the market. Of course, no doubt, when a bank raises money in the form of deposits, certain amount of deposits is what the bank is mandated to maintain in some form of reserves. Am I right? Cash reserves ratio, CRR, SLR, statutory liquidity ratio. And this is basically as per the RBI mandate. You have no option. You are bound to. Let's say your total reserves, the RBI mandates you to maintain is 30%. Let's say some part in CRR, some part in SLR. Let's suppose the total reserves you are obliged to maintain is 30%. That means 100 rupees may some money in the form of CRR, some money in the form of SLR. And if that sums up to be, let's assume 30%, you only have 70 rupees to lend. So, if you accept a deposit of 100, it doesn't mean that the bank would be having freedom to lend all 100, because there is some mandatory reserve the banks are mandated to maintain. So now you have 70 rupees to lend. But you could only lend when there is a demand for money. And when you could only lend when you think that the person who is willing to borrow is a credit worthy. Just because you have money, you cannot keep on calling the people and simply say, bhai, dekho, mera paas paisa, I am not able to lend this money to market. So no matter what credibility you have, I still prefer lending to you. No, that's not what the basically risk the the bank would take. So you could only lend when there's a demand, and you could only lend when you think the party is credit worthy, isn't it? After going for a due diligence. So you see, when there is no enough demand for a liquidity, when there is no enough demand for credit in the market, what happens? The banks might be left with some surplus cash. So when you are generally left with some surplus cash, which you think you cannot afford to lend to the market because maybe there is not enough demand. Maybe you think the economy is experiencing a crisis and you think it's not worthy taking a risk by lending money to the market. Why? At times of contraction or at times of crisis, if you go for reckless lending, what might happen? Maybe you are all aware of what happened prior to 2014, the twin balance sheet problem, the non-performing assets, isn't it? Right? The same thing might get repeated. What if I lend money to the markets without just going for proper due diligence? And good amount of my borrowers have ended up defaulting because the economy is experiencing severe contraction, and that would result in accumulation of losses to my borrower, and that would have an adverse effect on my balance sheet, isn't it? Pehle iska balance sheet turns to become bad, and my balance sheet, because since I am one of the largest financier, I do also experience a loss in value of my assets. My assets also become non-performing assets. So that being the reason, every time a bank mobilizes a deposit of 100 rupees, it's not necessary the bank would be able to lend all the money that it could afford to lend. In this case, 30 rupees, agar if you happen to maintain as a reserve, and you might not be able to lend all the rest of 70 rupees. So in general, banks might kabhi left with a certain excess reserves, some cash. So generally, what's a common thing? Banks, rather than keeping this in the form of cash, they mostly prefer converting into government securities because they do pay a certain rate of interest and they're also liquid. So that's a common practice. Rather than keeping idle cash, they prefer keeping in the form of government securities. The reason, the government security, they are highly secure, reason government is not going to default, and the interest, kam se kam thoda interest rate milta hai, and at the same time they are liquid. But it's not necessary that you always need to convert all of your excess reserves in the form of government securities. The banks would also prefer keeping some part of its reserves or excess reserves in the form of cash. But even then, rather than keeping cash with you, what if you have someone who is willing to take your cash in the form of deposits and pay an interest rate on it? And that's where the SDF comes into picture. So what does RBI says? You, my banks, in case you have some excess reserves, rather than keeping the idle cash in your wallet, why don't you park with me in the form of deposit for which you get paid an interest rate? So the only difference between reverse repo rate and SDF is, in this case, RBI is borrowing against a collateral, but in this case, when it comes to SDF, the banks are parking their surplus reserves or excess reserves in return for a certain rate of interest. Like the way we park our surplus cash after meeting our basic consumption requirements and then tax expenses. What we do, agar if we've been left with certain amount of money, we just place in the form of savings with the bank in return for a certain interest rate promised. Very similar. So since these rate of interest, if you have noticed it, okay, these rate of interest as of now are linked or anchored to repo rate. So I'm going to ask you a very simple question. So I have given you, okay, explain repo rate, explain reverse repo rate, and explain MSF, and then okay, and I already explicitly made it clear that it's always equal to bank rate, and I also explained SDF, standing deposit facility rate. You tell me what do you think could be the relation between these rates. So what should be more, what should be less? Okay, so find out whether SDF has to be more than reverse repo rate or less than reverse repo rate, or repo rate should be more than this or less than this. So what should be the relation is what I will leave it to you. Of course, you could get an answer by simply just looking at, okay, isn't it RBI website, but just simply think, this is the lending rate, this is the borrowing rate, and this is the deposit rate, and this is the flexible lending rate. So what should be the ideal relation? Alright, and I think okay, every one of you might be aware of these rates, but let me also add up the other one, that is variable repo and variable reverse repo. Variable reverse repo. Variable repo rate and variable reverse repo rate. In fact, the only thing I have done in this case is I have added a term called variable. So looking at the word itself, you would be able to make it out. It's not a fixed, rather it varies. Why? Why does it vary? Why do we call it a variable reverse repo rate? Okay, if you just put your mind, you could easily make it. So let's say take the case of a repo rate. I would explain in case of repo rate, then you could apply the same logic even in case of reverse repo rate. Let's say here is the RBI, which says that I am willing to lend money in case you need money for meeting your short-term requirement. You could approach me. You could approach me, and I am simply saying, come say come, the interest rate I would like to charge is 6.5%. I am willing to lend money, and the minimum rate I am expecting from you people is 6.5%. And anyone interested, you could simply approach me. You could approach me to raise the money, to borrow money, but the thing is that you need to place a collateral, that is the government securities. And I would prefer lending money to those people who would be promising an interest rate better, isn't it? I mean, in fact, it's something like an open bidding. You could participate, an open auction for the money I am willing to lend. Alright. So, iska matlab hai, I am willing to lend, but that is against a collateral. That's against a collateral. And whoever is promising me the rate of interest more, to him or her, I prefer lending money. It's something like an open auction. I am just simply putting money for lending, and whoever interested in paying more than the benchmark rate, I am willing to lend this money. So that's a very basic reason that whatever the money the banks borrow under the repo window is not necessarily exactly at the fixed repo window. It could be varying. The same thing goes with reverse repo rate. RBI might have promised a certain rate at which it is interested in borrowing, but banks might go for a different, quoting a different rate of interest at which they are interested in lending. So that's the basic reason. The actual rate at which RBI borrows money from the banks could be different from the fixed reverse repo rate. So I hope now it's clear. The repo rate, reverse repo rate, variable reverse repo rate, MSF rate, standing deposit facility rate, and bank rate. So in fact, it is mostly these instruments the central bank uses to influence the liquidity in the markets, and along with which the other commonly used or the other common practice is open market operations. And how do you define open market operations? The practice of central bank selling or purchasing G6. So either the RBI sells or RBI buys it from the market. And what do you think would be the potential impact of selling or buying the government securities from the market? As you know that let's suppose the RBI is selling the government securities to the market. So when you sell a bond or when you sell a government security, and you know the fact, obviously the buyer is expected to pay you back some money in return for the security you are selling. So what's happening? The money is basically flowing from the markets to the central bank, right? But whereas when you purchase the securities from the market, so you receive the government securities, in turn you're going to pay back the money, some cash. So that's how by buying them you're infusing the cash, and by selling you're just simply squeezing the cash. So whatever the practice, whatever you have done using those rates of interest that I already discussed, more or less is what you're going to do. At the end of the day, your objective is to infuse the liquidity in the market by simply conducting the open market operations. So in general, if you look at the monetary policy is conducted mostly using the rates of interest that I already discussed, like repo, reverse repo, variable reverse repo, MSF, and the other is open market operations. So this is a very common practice. Basically these are the quantitative tools the RBI has at its disposal to influence the supply of money in the economy. And you know, by influence supply of money, you could influence the interest rates in the market, or in fact, by using these interest rates, you're just influencing the interest rates in the market, and that is something could influence the aggregate demand, which we already discussed when we discussed about inflation. I hope you're following. So now just let's look at the current monetary aspects. But before that, just look at this question. Which of the following statements is or correct regarding the Monetary Policy Committee? It decides the RBI benchmark interest rate. It's a 12-member body including governor of RBI and is reconstituted every year. No, neither. Okay, it's not a 12-member committee, nor it's reconstituted every year. So this is the wrong statement. It functions under the chairman of Union Finance Minister. No, even in fact, the government has no say or no participation in the MPC. Henceforth, the first statement will be the right. Now let's look at. Remember, we started this discussion saying that the interest rate in the market as of now is being kept around 6.5%. Okay, so the question is, if the RBI decides to adopt an expansionist monetary policy, which of the following would it not do? It not do. In fact, you need to focus more on not do. So you just simply give me an answer. As of now, is the RBI going for an expansionary policy or a contractionary policy? What is really happening in India? Okay, is RBI going for an expansionary policy or a contractionary policy? What kind of policy as of now RBI happens to conduct? Expansionary or a contractionary policy? Okay, you just give me the answer for it, and let's look at the question. If RBI decides to adopt an expansionist monetary policy, what do you think RBI would not do? That's the question. And if you think it's difficult to answer, it seems confusing, then you just simply look at what it would do. Then you could just simply go for getting the right answer. If the RBI decides to adopt an expansionary monetary policy, isn't it? If you decide on expansionary monetary policy, you ideally go for cut and optimize SLR. Because reduce the SLR, reduce the reserves, the banks would have more money to lend. Increase the MSF rate is what you don't like, prefer doing if you would like to go for an expansionary policy. Cut the bank rate, repo rate. Yes, if you bring down the long-term rate and short-term rate, then obviously it results in expansionary policy. But since the question is about what you would not do, so obviously the answer happens to be got it. So now let's look at the current. Okay, I'm just giving you the important points as part of this chapter, the highlights. That's what the going through in this chapter, or what the remembering. The first thing, the monetary policy maintained a status quo on the policy repo rate at 6.5% in 24. It focused on withdrawing accommodation to ensure that inflation gradually aligns with the target while supporting growth. And this is something we already have discussed. And the second is what's the impact right now, and okay, how did the banking sector and financial sector happens to fare in the year of 24. Okay, and one interesting thing maybe you're all aware is the NPAs have been the least, and it's roughly around 2.9%. If you just look at some 12 years back, around roughly around 10 years back, the NPS were around more than 12%, and now it has come down to 2.9%, and that was one of the great achievement of the current government. So they have successfully brought down the NPS by around up to 2.9%. So there's a double-digit broad-based growth in bank credit. Gross and net NPS are at a multi-year low. So what do you mean by net NPA? I suppose you understand the definition of NPA, non-performing assets. Isn't it? The accounts of borrowers who default on repayment of loans. That's it. The account of borrower who default on repayment. So generally in India, the common accounting practice to categorize a bad loan as an NPA is minimum of 91 days. I mean, if someone happens to default for a period of more than 90 days, we categorize that particular loan as a non-performing asset. I suppose you will be able to recollect, okay, isn't it? Special mention account 0, and then 1, and then 2, and beyond 90 days, we do generally categorize as a non-performing asset. And then we have substandard, doubtful, loss making. I'm not going into that part right now. We don't have enough time. But generally, gross NPS refers to the total loss making assets, or simply the loans that are not performing, accounts of borrowers who default on repaying of loans. Then what is net NPA? Can someone answer the question? Net NPA. Yes. So when I say net NPA, is NPAs adjusted after the provision requirements. After your provision requirements. What do you mean by provisioning? See, provisioning is a very common practice in every business. If you happen to expect someone in future is going to pay you money, or if you happen to sell goods on a credit basis, it's not necessary the party who happens to make a commitment to pay in future would be able to keep his promise. What if the party defaults? So here in this case an NPA. The NPA might turn to become a loss making asset. What if Abhitona he is not able to service your debt? But what if he ends up simply saying, I am literally bankrupt and I cannot afford to repay your debt? So iska matlab hai, at some point of time, there are great chances the banks might not be able to recover all the amount of money it has lent to the markets. So there might be a reason wherein banks might go for taking some haircut. I mean, would not be able to recover all the loans it happens to extend to the markets. And in such case, in order to cope up that future losses, the practice every bank, in fact every business does, is just simply keep aside some capital to address those kind of challenges. So provisioning is basically a practice of parking or keeping some aside, some capital to address this particular future requirements. Because what if some of the loan might end up becoming a loss making asset and you will not be able to recover, and if you want to sustain a business, you should have some cash to overcome the challenge. So that being the reason, whenever the bank happens to categorize an asset as an NPA, the first and foremost thing it does is it has to keep some cash aside or capital aside to address any unforeseen loss that might result out of this non-performing asset. So after adjusting these provisions from the NPAs, gross NPAs, what we get is net NPAs. And what's the reason behind this falling gross NPAs, and then the reason behind falling net NPAs is, maybe you all aware of the fact, as soon as the new government came to power 2014, one of the major initiatives the government has taken is to address the challenge of NPAs in the banks. So by simply resorting to various initiatives, by simply insisting the banks to recognize the NPAs, and then For those banks which are in need of capital to meet their provisioning requirements, the government of India also happens to go for infusing fresh capital in the banks in the name of recapitalization. And later the government happens to bring in some reforms too. But I don't really think I could spend enough time on simply discussing all this part. But maybe you are already aware of the fact how the government of India since 2014 has tackled the twin balance sheet problem. Got it? So it is because of these initiatives the state has taken since the year of 2014. Now the the balance sheets of banks have become more healthy. And the overall NPAs have come down to a great extent. And that's what before elections the government happens to openly announce in the parliament that it has taken credit for making or keeping or cleaning the entire balance sheets of banks, especially the public sector banks. Okay. And the other most important thing is related to the capital markets of India. So this is one of the most interesting things that you need to remember. Not only India is the fifth largest economy in nominal terms, or third largest in terms of PPP, which is a fact, you're already aware of the fact, but you could also remember the fact the market capitalization of Indian stock market has seen a remarkable surge, and now the market capitalization to GDP ratio being the fifth largest in the world. What's the meaning of it? The market capitalization to GDP ratio. So how do you define a term market capitalization? How do you define a market capitalization? You might have come across small cap companies, large cap companies, mid cap companies. So what is basically the meaning of the word market capitalization? It simply is the value, the market value of the share multiplied, or the market price of the share multiplied by the total number of outstanding shares of the company. So that's basically the market value of a company. And now here in this case, we are just looking at the total market capitalization of Indian stock market. And if you just look at the market caps of Indian markets, capital markets, we have to stand in the fifth. The reason maybe you might all be aware of the fact because of the isn't it, improvement in the infrastructure, the digital public infrastructure especially, and the penetration of internet even in rural part of India, the participation rate of investors, participation rate of people in the capital markets has enormously increased. In fact, you could say exponentially has increased. And that being the reason, in the recent interview of RBI governor, he explicitly mentioned one of the major reasons behind fall in deposit rates in India, the fall in deposit rates. I hope most of you might be aware of the fact. This is what's basically in news. The credit growth in India, the credit growth as of now in India has far exceeded the growth rate in deposits. And one of the reasons the RBI governor has given in the recent past is, he says, most of the investors or most of the people in India, rather than simply parking their financial savings in the form of traditional term deposits, he says most of them now prefer parking them in capital markets. So that itself is a proof that a good number of Indians prefer investing in capital markets, or the penetration the participation rate has enormously increased. And when you have good number of people chasing the few stocks in the market, obviously what might also happen, many a times the stock market might also experience a temporary boom, isn't it? So in fact, the rise in Sensex or Nifty clearly says the fact that there is an increasing participation rate, and at the same time a good number of investors chasing those few stocks that's trading in Indian markets. So that's basically the the takeaway with respect to capital markets. And now the other important thing that we need to look at is related to insurance. And the government has a target, that is want to ensure, because though we have good number of public sector undertakings who are offering insurance services, but the penetration of insurance services in India is pretty poor. And that's being the reason the government happens to come with an initiative that insurance for all by 2047. In fact, I think by 2047, maybe you also know the fact the government has come with the object of Vikshit Bharat, where the government want to ensure that will be recognized as a developed country with a minimum per capita income of $10,000. So in the process of achieving this objective, the government also had a great target by name insurance for all by 2040. So when I say insurance, it could include health insurance, life insurance. I hope you understand there are different types of insurance. So as of now, the penetration being relatively very bad, then our government want to increase it. And what's basically the step the government proposes to ensure penetration of insurance services is what I will let you know. And then the other important thing, the presence of what really helped. So the last statement is what really helped India achieve this performance. It's basically the digital public infrastructure. The digital public infrastructure and involvement of banks and microfinance institutions have contributed to the improvement in financial inclusion. So now let me ask you people, what do you think would be considered as part of digital public infrastructure, especially in case of finance? Digital public infrastructure. Name something that you think would be part of digital public infrastructure, and I want you to not list simply all the isn't it, different types of digital public infrastructure, but I just want only in case of finance. Yes, can I say UPI? And I don't think it requires an explanation. And in the recent past, just around 1 week back, the RBI governor also has come with one more initiative, that is ULI. So this is a payment interface, and now he just want to propose a lending interface to ensure access to credit, isn't it? Would be easy and accessible to all the people in the country. Got it? So these are certain initiatives that government happens to bring in. And in fact, it is this kind of digital public infrastructure that happens to make it easy for people to access capital markets, and also has resulted in a financial inclusion. Maybe you all been aware of the fact that Jan Dhan Yojana, and then Aadhaar, mobile and bank account, isn't it? Right? So these kind of initiatives is what's the primary reason behind improvement in participation, and also has resulted in a better financial inclusion. All right. So before going ahead with let me also make it clear with what was the basic events that happened in 23-24, especially related to the banking sector. So I guess you all know the fact, as part of clean note money policy, or clean note policy, the RBI is somewhere in the month of May, I guess, has started withdrawing 2000 rupee notes. That's one major event that happened. And the second is not necessarily with respect to Government of India. The second major event, that's what we're discussing, is HDFC has been merged with the HDFC Bank. HDFC has been merged with the HDFC Bank. In fact, these are the two major events. That's what we're taking a note that happened in the year of 23-24. So the question here in this case is, why do we need to discuss about HDFC merger? Because basically this is a private bank. In fact, maybe you are already aware of the fact HDFC is different from HDFC Bank. When I say this merged with it, does mean there happen to be two different entities. So HDFC, I guess it stands for Housing Development Finance Corporation. It's an institutional financial, like ICICI, Industrial Credit Investment Corporation of India, way back has been acquired by ICICI Bank or merged with it. So in fact, I would say a developmental financial institution. Isn't it? Maybe this is somehow you would be able to recollect. DFI, it's basically a DFI, has been merged with HDFC Bank. So no more you have a DFI by name HDFC. Now the entire balance sheet of HDFC has been merged with a commercial bank, a universal bank. Obviously, what might happen? जो भी capital इसका पास है, now would be part of this bank. Isn't it? So, and at the same time, what the RBI has done, it started withdrawing 2000 rupee notes as part of its clean note money policy. And what happened is, especially because of this event, the deposits in Indian bank started increasing. When the deposit starts increasing, because people started simply taking back their 2000 rupee notes, and the RBI has explicitly said, since there is enough liquidity available in other denominations, I'm not gonna simply introduce back this 2000 or any other denomination. The reason RBI has said is we already have enough liquidity in the market that is good enough to meet the requirements in spite of withdrawing this 2000 rupees. So that being the reason, what happened, a good number of people who deposited might not have withdrawn money in return for it. So when the deposits within the banks increases, then obviously the expectation is the bank might go for resorting to lending more money. Because when I have excess amount of money in the form of deposits, more cash available in kitty, then obviously banks prefer lending. Isn't it? So now the question is, at times the inflation is really high. What if the banks now resort to excessive lending, reckless lending? That being the reason, the RBI has come with an innovative initiative. And that's where somewhere in the month of August, it has proposed something called incremental cash reserve ratio. And what does it mean? As part of this incremental cash reserve ratio, or as per this incremental cash reserve ratio, the banks are mandated to park 10% of the deposits mobilized since the month of May with RBI. I mean, the actual CRR is different. Okay, it's around 4.5%. But in order to ensure the banks would not resort to excessive lending because of increase in deposits due to the withdrawal of 2000 rupee notes, the RBI has insisted banks, that amount of money that you mobilize in the form of deposits due to the withdrawal of 2000 rupee notes, I want you to park 10% of those deposits since May 23. 10% of it is what you need to park it with me as in the form of a incremental cash reserve ratio. And the RBI also has explicitly made it clear that this particular cash reserve ratio you maintain with me would not be for a longer period of time, would only be for a temporary period of time. And by the promise, as per the promise made by central bank, the RBI has withdrawn this ICRR somewhere in the month of October 23. So in the context of monetary management or in the context of finance sector, the two things that you need to remember, or two major events that have taken place, is the withdrawal of the 2000 rupee notes and the merger of a very big DFI with a universal bank, commercial bank by name HDFC. And at the same time, you are already aware of the fact the interest rates are already being kept at a high rate of 6.5%. So most of you think when the interest rates are really high, maybe the banking sector might not be able to extend a good amount of credit. But contrary to your expectations, the banks in 23-24 happen to extend a good amount of credit, and there is an increase in credit offtake. And in fact, for your surprise, the rate of increase in credit disbursal is much more than the rate of increase in deposits as of now India. In fact, that itself is the reason why there's been a debate that the credit or the incremental credit rate is high than compared to the incremental deposit rates. So before going ahead with that particular discussion, let me ask you a simple question. So here is the question related to incremental cash reserve ratio. Which of the following statements about ICR is or correct? A temporary measure to manage excess liquidity in the banking system. And the second, RBI declared that banks will be required to maintain ICRR of 10% increase in their net demand and liabilities, NDTL. So I think you could notice both the statements are right. Let's look at the third one. RBI has withdrawn ICR in October 23. Even that happens to be right. Okay. In fact, if you want to be more precise, you could also say, and this ICR applies only with respect to those deposits mobilized after May 2023. So by that logic, the third option. And now, as such, you know that the other event I happen to insist is the RBI happens to withdraw 2000 rupee note as part of its clean note money policy. So now let me ask a simple question. just simply to test your understanding on currency in circulation and reserve money. In fact, the RBI also happens to explicitly make it clear, because of these two events, both CIC, currency in circulation, and reserve money has not increased by a great extent. In fact, the reason why, okay, you could get to understand the reason why the currency in circulation, reserve money has not increased by a major proportion if you could answer me this question. So the answer for the question is better you will be able to make it out if you answer this question. The question is, if you withdraw 1 lakh rupees in cash from your demand deposit account at your bank, the immediate effect on aggregate money supply in the economy will be. So what do you think is the immediate effect on the aggregate money supply in the economy? So for those of you who have a confusion with the currency in circulation, reserve money, or here in this case I use a term called aggregate money supply. So when I say aggregate money supply, I could rewrite the same as total money supply in simple terms. But for those of you people who have a confusion related to it, let me make it simple. Let's say you and I know the fact that RBI is the one who happens to issue the currency notes, notes, and the government of India is the one which mints coins. But whosoever happens to issue it, but it's basically the responsibility of RBI to bring it into circulation. So that currency, maybe in the form of notes or in the form of coins, and in the modern days we have a CBDC, central bank digital currency. No matter in whatever form, the currency that has been issued by the issuing authorities, that's the government and RBI, that's been introduced in the market, okay, is what you could call as currency in a circulation, but not basically, okay, is the actual currency in circulation. There is a difference between currency in circulation and currency in circulation with the public. So when I say currency in circulation, it's simply the money the central bank and the government happens to bring it into circulation. All the currency notes, all the coins, and all the CBDC, okay, in fact that basically constitutes a very minuscule part, but whatever the currency that's been brought into circulation. Got it? But it's not necessary all the currency the central bank happen to bring into circulation would be in the form of cash in hand with the public. So people don't keep all the cash in their pockets, right? So they do end up simply depositing some part of the money in the banks. And once the banks happen to receive these deposits, and you and I know the fact that deposits, out of every penny the bank accepts deposit, certain part of the money is what the bank is mandated to maintain with RBI as reserves. And these reserves, and especially when it comes to CRR, the reserve happens to be in the form of cash. So it has been whatever the currency the central bank introduces the market doesn't remain in the form of currency or a physical form of currency in the hands of the public. Part of the money gets deposited in the banks, and part of those deposits the banks happens to maintain with RBI, which is in the form of cash, what we call a cash reserve. Okay, and it is this particular money is what we refer as a reserve money, which is also referred as M0 or high powered money. And how do you compute it? The currency in circulation plus the deposits of banks with RBI, and then other deposits with RBI is ideally what we call reserve money or high powered money, or in fact this basically constitutes the monetary base of the economy. So this is what we call as the monetary base, and ideally cash in circulation is a part of the reserve money. So whatever right now the cash that has been with the public, which is in circulation, and the reserve money or high powered money basically constitute the monetary base. But the actual money that is in the economy, okay, maybe you might be, I may not, okay, so since we have very less time, I'm not going into the monetary aggregates of what M1, M2, M3 and M4 corresponds to, Because as such, you know the fact, once you deposit money, the banks are obliged to maintain some reserves. Against the reserves, bank could create credit. So what I'm saying is that the central bank and the government of India could issue currencies by printing or minting. But even banks could create money by not by printing or minting, by simply creating a credit against the reserves. I hope you're following, and I think you're able to figure out what basically is the difference. Central bank and the government of India could issue currencies, and they issue currencies through either by printing or government does it through minting the coins. But once you have this money in the banks, against the reserves the banks are mandated to maintain, they could create a credit, and through the process of credit creation, banks do end up creating one. And that's where, by summing up the money, with the banks and post offices, maybe if you could recollect, we have different types of monetary grids: M1, M2, M3, M4, the narrow money and broad money concept. So since I'm not having enough time, I'm not going into the explanation of what M1, M2, M3 corresponds to. So generally, the M1, M2 in India is what we refer as a narrow money, and M3, M4 is what we refer as a broad money. So when it comes to the monetary supply or the aggregate money supply, total money supply, we ideally refer to the M3, which basically corresponds to the M1, which is nothing but the currency with the public, demand deposits with the banks, and term deposits with the banks. Or you could write it as M1 is equal to M3 is equal to M1 plus term deposits with the banks. So the question here in this case is, if you withdraw 1 lakh in cash from your demand deposit at your bank, the immediate effect on aggregate money supply in the economy, what do you think is the immediate effect on the aggregate money supply? So what's the aggregate money supply? M3. And M1 obviously includes currency in circulation, right? Plus demand deposits with the banks, plus other deposits with the RBI, and then you have term deposits with the banks. So now the question is, what if you withdraw 1 lakh? Don't you think 1 lakh, debited from here gets added to your currency in surplus? So since you still have it on the form of cash in your hand, so there hardly any change in the right hand side. So what's basically the answer is, there is hardly any increase, in the total money supply. It leaves unchanged in the short. Got it? And by the same logic, so answer this question: the money multiplier in an economy increases with which one of the following? With which one of the following? What might result in increase in money multiplier? I assume that you know the formula for money multiplier. It's 1 by RR, reserve ratio, right? In fact, how do you compute the money, total money supply or aggregate money supply? It's nothing but your high powered money, or M0 multiplied by 1 by RR. So what basically determines the money multiplier? So that's the question. The money multiplier in economy increases with which one of the following? So since money multiplier is inversely related to reserve ratio, so you could easily make it out, lesser is the reserves bank maintain, more is the credit they could create. Am I right? So what would result in? Increase in cash reserve ratio? Cannot be. Increase in SLR? Increase in banking habits of the people brings more deposits. When you have more deposits, obviously you could create more credit. Right? So I hope you could make it out. And the next question: when the RBI it reduces SLR by 50 basis points. Remember I said 1 basis point is equal to 1% of 1%. So it is a reduction of 50 basis points has been reduces by 0.5%. So what do you think would be the most likely event that had happened? You could apply the same logic. Lesser is the reserves bank is mandated to maintain, more is the money it could lend. Isn't it? Let's say the mandatory reserve requirements of banks that includes CR and SLR is 90%. Iska matlab hai, out of every 100 rupees you accept deposit, you're gonna park 90 rupees in the form of reserves, and you only have 10 rupees to lend. So higher is the reserves, lesser is the money to lend. Lesser is the reserves, more is the money to lend. And you could apply the same logic. So what might be the most probable event that could happen? Commercial banks may cut their lending rates because they would now have more money to lend. So if this seems to be the obvious answer, I hope you could make it out. What could be the reason? Other cannot be an appropriate and most appropriate answers. Okay, and here is the next question. Already explained about variable reverse repo rate. So now look at this statement. Consider the following statements. Variable reverse repo rate would be more than reverse repo rate and less than repo rate. Is it right or wrong? Would be variable reverse repo rate would be more than reverse repo rate and less than repo rate. I mean, the relation between these three is what's been asked. So first and foremost, can reverse repo rate be more than repo rate? It can't be. Because reverse repo rate is the rate at which RBI borrows. Repo rate is which RBI lends. And it doesn't make sense charging more, isn't it, for borrowing when you are willing to borrow at a less rate. Something like reverse repo rate is your lending rate. Repo rate is your lending rate and reverse repo rate is your borrowing rate. And I don't really think you could simply borrow at a higher rate and lend at a lower rate. So maybe I hope you made it that this would be a nice. And MSF is less than the standing deposit facility rate. Standing deposit facility rate. Remember, already explained what is SDF. It's simply a deposit facility the RBI provides without any collateral. But MSF is a lending rate and SDF is a deposit rate. And by the same logic, you could also make it out. The same logic applied for statement, you could also apply for the second one. Marginal standing facility rate less than the standing deposit facility rate. Can it be? Or what do you think would be the relation between MSF? Should it be more than SDF or less than SDF? Yes, it's obviously more than, right? Okay, so since we are running out of time, I just want to quickly wind up about the other basic things. So this is about the credit creation. So there is an increase in agriculture lending this year. Iske alawa there hardly anything you need to worry about it. The second most important thing is primarily the focus on MSMEs. So in order to boost credit dispersal to MSMEs, as you already know, the government has come with a very great initiative in the name of Mudra loans. But along with which, the government also have to bring in certain other initiatives. One is emergency credit linked guarantee scheme. Though it's not the initiative of the last year, but basically there is an improvement in the total credit disbursed to MSMEs. That's what I just want to highlight it. And the second is introduction of trade receivables discounting system. So what do you mean by trade receivables discounting system? When I say trade receivables, you know the fact that when in basically day-to-day business operations, not all transactions are settled on spot. Most of the transactions do take place on a credit basis. So iska matlab hai, let's say imagine if I happen to sell some goods to a distributor. Imagine I am the one producing some goods and I happen to sell it to a distributor. The distributor might not be able to pay all the money that he is required to pay. What he might say is he makes a commitment to pay the money in future. And that's what I mean to say, in real world, most of the transactions do take place on a credit basis. So I might be procuring raw materials on a credit basis, and at the same time I might be supplying these same goods and services to my distributor on a credit basis. So generally what happens when it's on a credit basis, what the buyer do makes a commitment. In return for the amount of goods I have purchased, I do make a commitment to pay you back the money at a certain date, on a particular date. So those expected cash flows or those expected receipts I would receive in future is generally what we call trade receivables. Assume that you people are my distributors. I produce some pens and you are my distributors, and every month you purchase ₹1 million worth pens. But you say until unless I sell it back to retailers and the retailer again sells it to the market, I cannot mobilize enough cash to pay you back the money, and you just make me an offer. Why not take my collect my money from me after, let's say, 3 months late? Just you make a promise to pay me back 3 months later. So these particular receivables in return for the goods I happen to sell is what I generally call as a trade receivables. So it does mean if I am basically a producer who is producing pens, and after selling these pens, okay, 1 million rupees worth pens to a distributor, though I happen to sell, but still I have not received cash in my bank account. The reason? I happen to sell it on a credit basis. And I could simply consider these particular receivables from my distributor or from my buyer as my short-term asset, because I'm gonna get it back from this particular distributor in 3 months of time, that is around million rupees. But thing is that though the sale is made, since the cash is not received, so that being the reason, in my balance sheet I might receive, okay, report a short-term asset, but the problem is I might not have enough cash in my account. So there will be a problem with cash flows. So that's where, in order to ensure there will be enough cash available to the MSMEs, the government now has introduced a very great initiative by name Trade Receivables Discounting System. Matlab, I could take this piece of paper, that's been a paper where you made a commitment, my distributor made a commitment that I'm going to pay you back your money, let's say the million rupees, after 3 months. Alright, so I have a commitment by a party who is making me a promise that he is going to pay me 3 million, let's say million after 3 months. But the problem is I am badly in need of cash now. So it is in such case, I could take this particular paper to a banker and ask this gentleman, "Arey bhai dekho, here is a paper wherein my buyer has made a promise to pay me million rupees after 3 months. But since I need cash immediately, why don't you take this piece of paper? And in return for this piece of paper, why don't you pay me back the money?" But do you really think, since the paper guarantees a receivables of million rupees in 3 months, the bank would not be happy paying you million rupees now? The reason is million rupees 3 months later and million rupees now has a great difference. Why? Maybe if you could recollect time value of money. Am I right, sir? 1,000 rupees now is more valuable than 1,000 rupees a year later. So that's the basic reason. Since the paper guarantees a cash payment of million rupees after 3 months, now bank would calculate the present value of this million rupees. And that's what he pays to the seller. And this is what we call computing the present value of this future cash flows is what we call as a discounting. Maybe if you could recollect what is being discussed in the financial markets or capital markets class, you would be able to. Compounding, discounting. So you are just trying to find out the present value of future cash flows of million rupees, and इसी वजह से we call it discounting. So अगर if you have any such piece of paper wherein someone made a commitment to pay you a certain amount of money after a certain period of time, you could take that commitment to a banker. And now banker would discount it. That means he computes the present value and he pays you money in return for the paper. And in case if the banker is in need of money in this period of time, the banker again could rediscount with his banker, let's say from an RB. And that's what we call rediscounting. Maybe it is in this context you might have come across. Bank rate in India is generally considered as a discount rate. So when these bankers discount these bills of exchange or these trade receivables, I mean these kind of commercial bills, the rate at which they discount the future cash flows is at the bank. So now what RBI has done, in order to ensure the MSMEs in the Indian economy would have enough access to cash flows. So they also have been given opportunity where they could discount their trade receivables. So you don't need to wait for the next 3 months to collect your money. Rather, you could approach a banker and simply redeem it with the bank. And what do you think a banker is going to do? He would compute the present value of this million rupees that he is going to receive in the next 3 months and he pays you the money. So the very basic essence is to improve the cash flows to the MSME so that they would not be starved of any cash. So that's one important initiative, and I guess this is something which you are already aware. Okay, Ujjam portal is not something new, and then the credit guarantee schemes. Okay, so let me, and this has already been discussed, the gross NPS have been greatly reduced, and there is, okay, due to the enough recapitalization of banking. Okay, so the capital, okay, that is, sorry, capital requirements of banks is met through enough recapitalization. This part is what I already have discussed. Okay, and now let's close this discussion with the role that the asset reconstruction company in India happens to play. In fact, one primary reason, okay, what's been highlighted in the economic survey that helped in really containing this NPAs is the participation and the role the National Asset Reconstruction Company and many other asset reconstruction companies have played. And I suppose you might be aware of what is an asset reconstruction companies. So these companies are in the business of buying bad debts or the non-performing assets, and they do take the responsibility to recover. So it does mean they happen to buy the bad debts from the balance sheets of banks and they take the responsibility of recovery. That's what basically the business model of an asset reconstruction company, and due to a great role played by these asset reconstruction companies, okay, we also have experienced a great fall in NPS. Okay, and let's close this part with the basic, okay, since the notes as already, okay, I will be sharing the notes. So let's close this discussion with the last initiative, that's the insurance. So maybe this would be a probable question for your preliminary examination. The three major initiatives the economic survey has highlighted that government might bring in to achieve the objective of insurance for all by 2047 is Bima Sugam, an online portal to facilitate buying of insurance, and then Bima Vahak, a woman-centric insurance distribution channel, and then Bima Vistar. So I don't really think there is anything, okay, that's what the explaining in this part, and rest of this particular thing, okay, I mean issues that I have skipped because I am running out of time. It's been almost more than 3 hours. So I'm really sorry for the delay, okay, isn't it? And I will have some technical issues, but I'll share this PPT with you and that would help you to revise the rest of it. Okay, that's it. Thank you. Good night.